The first learning objective is to determine how changes in volume affect costs. But first we have to define three types of costs: variable, fixed, and mixed. The topic of this chapter is cost volume profit analysis, also known as CVP. The first question we'll tackle is, how do costs change as there is a change in volume? We are familiar with the income statement, whose formula is revenue minus expenses equals net income. This particular income statement shows 4 consecutive quarters. Let's say that Lisa starts a tiny company that sells jeans out of her parents' garage. Lisa is a college student and decided to start a small business operating out of her parents' garage. Her business is a merchandising business that sells jeans. Lisa sells jeans for $50 that she buys for $25. And let's say this small company's sales rose each quarter. So Lisa's business has rising sales volume. As Lisa made more sales of jeans, what would happen to her cost of goods sold? It would also rise. That's because as she sells more jeans, she has to buy more jeans to meet the demand, so cost of goods increases. Because the cost of goods sold increases as sales volume increases, cost of goods sold is a variable cost because its total varies with sales volume. Now let's look at another cost, rent. Let's say that Lisa's parents charge her $100 rent per quarter to use the garage for her business. Because this cost does not change as the volume of jean sales changes, it's considered a fixed cost, because changes in sales volume does not affect the cost. Whether she sells 0 jeans or 50 jeans, rent will still be $100 per quarter. Using cost volume profit analysis, Lisa could determine how many jeans she would need to sell to make a profit. So now we'll discuss the 3 different types of costs: variable costs, fixed costs, and mixed costs. So let's start with variable costs. Variable costs are costs that increase or decrease in total in direct proportion to increases or decreases in the volume of activity. So that leads to the question, what is volume? Volume is the measure or degree of an activity of a business action that affects costs. In other words, the more volume, the more cost is incurred. Some examples of volume could include the number of units sold, the number of units produced, the number of miles driven, or possibly the number of phone calls placed. For all examples in the videos and homework, when classifying costs as either fixed or variable, classify them relative to the number of units produced or sold, unless told otherwise. TEDS Tablets builds and sells touchscreen tablet computers. The direct materials that are used to make the tablets are a variable cost. The more tablets TEDS Tablets produces, the higher the variable cost in total. The less tablets that are sold, the lower the variable costs are in total. An example of a direct material for a tablet is the battery each tablet requires. Now let's look at a chart that shows the costs for batteries at various levels of production. We'll assume each battery costs $55 per battery. So if TEDS Tablets produces 0 tablets, they have 0 variable costs for batteries. But if they produce 100 tablets, they'll have a total variable cost of $5,500. We get that by multiplying 100 tablets times the $55 per battery. So keep in mind the variable cost per tablet remains the same at $55. But the variable costs in total vary depending on the volume of touchscreen tablets produced. Here's a graphical look at the variable cost of the batteries. So all I did was I took the chart from the previous slide and made it into a graph. As you can see, the total variable cost of batteries increases proportionally as the number of tablets produced increases, but the battery cost per tablet does not change. The slope of the line is $50 per tablet, and we can calculate the slope of the line by taking the change in total battery cost and dividing by the change in number of tablets produced. But the key takeaway in this slide is total variable costs fluctuate, but the variable cost per unit remains constant, in this case, the $55 per tablet. Moving on to fixed costs. A fixed cost is a cost that remains the same in total, regardless of changes over wide ranges of volume of activity. Common examples include rent, salaries, property taxes, and straight-line depreciation. So as the number of units that the company produces increases, these costs do not change. That's why they are fixed costs. So suppose Ted's Tablets incurs $12,000 of rent each month. No matter how many tablets they produce, the rent is always $12,000 per month. If they produce 0 tablets, rent is $12,000. If they produce 100 tablets, the rent is still $12,000. And any production level in between results in the same total $12,000 of fixed costs. So now let's calculate the fixed cost per tablet. We'll start out at the production level where we produce 25 tablets. So to calculate the fixed cost per tablet, we simply take the $12,000 of fixed costs and divide by 25 tablets to get a fixed cost per tablet of $480. At the 50 tablet level, the fixed cost per tablet falls to $240 per tablet. At the 75 tablet level, it falls further to $160 per tablet. And finally, at the 100 tablet level, the fixed cost per tablet falls to $120 per tablet. So even though total fixed costs do not change, fixed cost per unit does change. So as the number of tablets increases, the fixed cost per tablet decreases. This means that fixed costs per tablet are inversely proportional to the number of tablets produced. This is just a fancy way of saying that as the number of tablets produced increases, the fixed cost per tablet decreases. So just to recap, with variable costs, total costs change proportionally to changes in volume. When volume of tablets produced increases, total variable cost increases. When volume decreases, total variable cost decreases. But the cost per unit remains constant with variable costs, such as the $55 cost per tablet for the battery. With fixed costs, it's the exact opposite. Total fixed costs remain constant when we compare to volume. Our example was the $12,000 of rent per month, but fixed costs per unit changes inversely to changes in volume. When volume increases, fixed costs per unit decreases. When volume decreases, fixed cost per unit increases. Not all costs can be classified as either fixed or variable. Costs that have both variable and fixed components are called mixed costs. Examples include compensation for sales representatives. For example, they may get a fixed salary per month, that is the fixed cost, but they also get a commission based on the units they sell, that is the variable cost. Vehicles are another example. The vehicle insurance would be the fixed cost, And your variable costs are things like gas, oil, and maintenance that are based on the number of miles driven. Another example is a cell phone plan that charges a set amount per month, plus additional charges per minute of use. So let's talk about a mixed cost for TEDS tablets. TED's cell phone provider charges $100 per month to provide the service, plus 10 cents for each minute of use. This is a mixed cost and has both a fixed and a variable component. With this information, we can create a table that shows the cost for the cell phone at different levels of activity. If the cell phone is used for 100 minutes, the company will bill TED $110. 100 of it is the fixed cost per month, plus the variable cost of 100 minutes times 10 cents per minute, which gives us $10 of variable costs. If they talked on the phone for 500 minutes, the fixed cost is still $100, but the variable cost rises to $50 due to the 500 minutes times 10 cents per minute. The total cost is then $150. Here's what a typical graph would look like for a mixed cost. It's graphing the cell phone plan of $100 per month plus 10 cents per minute of use. Total costs are on the y-axis, and total minutes used are on the x-axis. Notice the orange line is flat. This represents the $100 fixed cost of the cell phone plan. So no matter if Ted uses the phone for 0 minutes or 500 minutes, he's being charged the $100 flat fee. And variable costs are anything above the orange line. And total costs are represented by the green line. Any minute of cell phone use increases the total cost by 10 cents per minute. So technically the slope of the line is 10 cents per minute. In the next video, we'll learn how separating mixed costs into their fixed and variable components can allow management to determine how many units they need to sell to break even, or how many units they need to sell to reach a certain profit target, such as $1 million.